After 60 years of battling governments, central banks, and political establishments around the world, I've learned something that most investors never figure out. Governments lie. Not occasionally, not just during election seasons, constantly, systematically, and most dangerously for your wealth, they lie about economics. They lie about inflation. They lie about unemployment. They lie about economic growth. They lie about their ability to manage debt, control markets, and deliver on their promises. And millions of investors believe these lies, base their financial decisions on them, and lose enormous amounts of money when reality inevitably contradicts the official narrative. I've made billions of dollars by betting against government lies. In 1992, when the British government claimed they could defend the pound indefinitely, I borrowed $10 billion and bet against them. They were lying about their capabilities, and I made over $1 billion in a single day, proving it. In 1997, when the Thai government insisted their currency was stable and their economy was strong, I positioned against the baht months before it collapsed. They were lying about their financial position, and I profited enormously when their lies became impossible to maintain. In 2008, when governments around the world claimed the banking system was sound and the economy was fundamentally healthy, I had already positioned for crisis because I could see through their propaganda to the underlying reality. Here's what most people don't understand. Governments don't lie because they're evil or malicious. They lie because telling the truth would often trigger the very crisis they're trying to prevent. So they create narratives, manipulate statistics, and promote policies that sound good, but violate basic economic reality. The problem is that as an investor, believing government lies will destroy your wealth. Political narratives and economic reality are often completely opposite. When governments claim everything is fine, that's usually when you should be most worried. When they promise easy solutions to complex problems, that's when you should be most skeptical. Today, I want to share with you the 5 most dangerous government lies that investors fall for repeatedly. These aren't partisan political statements. These are economic falsehoods that transcend party lines and national borders. They're lies that politicians of all stripes tell because they work in the short term, even though they create disasters in the long term. Because here's the uncomfortable truth. We are living through an era of unprecedented government deception about economic reality. Central banks claim they can control inflation without consequences. Politicians promise they can spend unlimited money without paying a price. Regulators insist they can prevent crises that are already inevitable. These lies are setting up the biggest wealth destruction event in modern history, and the only way to protect yourself and potentially profit from the chaos is to stop believing what governments tell you and start analyzing what they actually do. Government lie number 1, we can control inflation without consequences. The first and most dangerous lie that governments tell is that they can control inflation without any negative consequences for the economy or society. Central banks and politicians want you to believe that they have precise tools to manage price levels, that they can stimulate growth when needed and cool down the economy when necessary, all without creating serious side effects. This is perhaps the most destructive lie, because it gives people false confidence in government monetary policy and encourages them to ignore the obvious signs of currency debasement happening all around them. I've watched this lie destroy entire economies throughout my career. In the 1970s, I watched the Federal Reserve under Arthur Burns claim they could manage inflation through fine-tuning while simultaneously pursuing policies that created the worst peacetime inflation in American history. They kept insisting they had the tools to bring prices under control without causing recession, right up until they were forced to raise interest rates to 20% and trigger the deepest recession since the Great Depression. The mathematical reality is that inflation is always and everywhere a monetary phenomenon, as Milton Friedman correctly observed. When governments create more money than the economy produces goods and services, prices rise. This isn't complicated economics, it's basic arithmetic. But governments hate admitting this because it means acknowledging that their spending and monetary policies have consequences they can't control. During the European debt crisis of 2010-2012, I watched European central bank officials repeatedly claim they could manage inflation expectations while simultaneously pursuing quantitative easing policies that were obviously inflationary. They insisted they had modern tools and sophisticated models that would allow them to expand the money supply without triggering price increases. The reality was that they were trapped by their own previous promises and couldn't admit that their policies were creating exactly the inflation they claimed they could prevent. They kept moving the goalposts, changing their definition of price stability, and insisting that temporary price increases were transitory even as they became permanent. Today, we're seeing the same lie on an unprecedented scale. Central banks around the world have expanded their money supplies by trillions of dollars over the past 15 years, claiming they can do this without creating inflation because they have better understanding of monetary transmission mechanisms. The Federal Reserve spent years insisting that inflation was below target and needed to be stimulated. Then, when inflation exploded past their targets, they claimed it was transitory and would naturally subside without policy changes. When it became clear that inflation was persistent and broad-based, they shifted to claiming they could bring it down through precise calibration of interest rates without causing recession. Each phase of this narrative was a lie designed to maintain confidence in their competence and avoid admitting the obvious, that they had created an inflation problem through excessive money creation, and that solving it would require significant economic pain. Here's why this lie is so dangerous for investors. It encourages people to hold cash and fixed income investments that get destroyed by inflation. When you believe the government can control inflation, you don't take the steps necessary to protect your purchasing power. I learned early in my career to watch what central banks do, not what they say. When they're expanding the money supply rapidly, inflation is coming, regardless of their promises. When they're trapped by political pressure to keep interest rates low despite rising prices, currency debasement is inevitable. The practical implication for investors is clear. During periods of excessive monetary expansion, you need to own real assets, stocks, real estate, commodities, precious metals, things that maintain their value when currencies lose purchasing power. Government promises about inflation control are worthless if they conflict with the mathematical reality of money creation. Government lie number 2. Government spending creates real economic growth. The second lie that destroys investor wealth is the persistent claim that government spending creates real sustainable economic growth. Politicians of all parties promote this fiction because it justifies unlimited spending on their favorite programs while promising that such spending will somehow make everyone richer. This lie is particularly dangerous because it sounds intuitively reasonable. If the government spends money on infrastructure, education, or research, shouldn't that stimulate economic activity and create jobs? The problem is that government spending doesn't create wealth. It redistributes wealth from the productive sector to the political sector. I learned this lesson during the stagflation crisis of the 1970s, when governments around the world dramatically increased spending in response to economic weakness, only to discover that they had made the problems worse. The Keynesian economists of that era promised that government stimulus could restore full employment and strong growth without triggering inflation. The reality was exactly the opposite. Massive government spending created inflation without producing real growth, leading to the economic stagnation that persisted throughout the decade. The governments had confused monetary expansion and fiscal stimulus with genuine wealth creation. Here's the fundamental problem. When governments spend money, they must first obtain that money either through taxation, borrowing, or money creation. Each of these methods removes resources from the private sector, where they would be allocated according to market signals and consumer preferences, and redirects them according to political considerations. Taxation directly reduces private sector resources available for investment and consumption. Borrowing crowds out private investment by competing for the same pool of savings. Money creation dilutes the value of existing money holdings, effectively taxing everyone who holds cash or fixed income investments. During the 2008 financial crisis, I watched governments around the world implement massive stimulus programs while claiming these would restore economic growth quickly and permanently. The Obama administration promised that their $800 billion stimulus package would prevent unemployment from rising above 8% and create millions of shovel-ready jobs. The actual results were dramatically different. Unemployment peaked at over 10%. The economic recovery was the slowest since the Great Depression, and most of the stimulus money was wasted on politically connected projects that created few permanent jobs. But government officials kept claiming success and arguing for even more spending. The same pattern repeated during the COVID-19 pandemic, when governments implemented multi-trillion-dollar spending programs while claiming these were necessary for economic recovery. Politicians promised that massive spending on everything from unemployment benefits to infrastructure would create sustainable growth and build back better. What actually happened was predictable: massive inflation, supply chain disruptions, labor shortages, and economic distortions that persisted years after the initial crisis. But governments refused to acknowledge that their spending programs had created these problems, instead blaming external factors and calling for even more intervention. Here's why this lie is crucial for investors to understand. Government spending programs create temporary booms in certain sectors, followed by inevitable busts when the artificial demand disappears. If you're investing based on government promises about spending-driven growth, you're setting yourself up for losses when reality asserts itself. The sectors that benefit most from government spending: renewable energy, infrastructure construction, defense contracting, healthcare administration, often become dependent on continued political support rather than developing genuine competitive advantages. When political priorities change or fiscal constraints force spending reductions, these sectors collapse. Smart investors learn to distinguish between genuine economic growth driven by productivity improvements and innovation and artificial growth driven by government spending and monetary expansion. Real growth creates sustainable wealth that compounds over time. Government-driven growth creates bubbles that eventually burst. The practical approach is to invest in companies and sectors that create real value for consumers rather than those that depend primarily on government contracts or subsidies. Look for businesses that would thrive even without political support, and be very cautious about investments that require continued government spending to remain viable. Government lie number 3. We can prevent economic cycles and market crashes. The third devastating lie is that governments and central banks have the knowledge and tools to prevent economic cycles and market crashes through sophisticated policy interventions. This arrogance about their ability to manage complex economic systems has led to some of the worst policy decisions in modern history. Politicians and central bankers want you to believe that they've learned from past mistakes and developed better models, smarter regulations, and more precise tools that allow them to smooth out economic volatility and prevent financial crises. This confidence is not only misplaced but actively dangerous, because it encourages risk-taking based on the assumption that authorities will prevent serious downturns. I've watched this hubris play out repeatedly throughout my career, always with the same result. Government attempts to prevent normal market corrections create much larger problems that eventually explode with devastating force. During the 1990s, Federal Reserve Chairman Alan Greenspan became known as the maestro for his supposed ability to fine-tune the economy and prevent recessions through precise interest rate adjustments. The financial media praised his Greenspan put, the implicit promise that the Fed would intervene to prevent major market declines. This confidence in government market management encouraged investors to take extraordinary risks because they believed the Fed would always rescue them from serious losses. The result was a series of increasingly dangerous bubbles, first in technology stocks, then in housing, each one larger and more destructive than the last. When the dot-com bubble burst in 2000, instead of allowing normal market forces to clear out the excesses, Greenspan cut interest rates to historic lows and flooded the system with liquidity. This prevented a normal recession, but channeled speculative excess into housing markets, creating an even larger bubble that nearly destroyed the global financial system when it finally collapsed. The fundamental problem is that economic cycles are not bugs in the system that can be eliminated through better policy. They are features of how market economies naturally adjust to changing conditions, technological innovations, and shifting consumer preferences. Attempts to prevent these adjustments don't eliminate them, they postpone and amplify them. During the European debt crisis, I watched European officials repeatedly claim they had the tools to prevent sovereign defaults and maintain stability through bailout mechanisms and central bank interventions. They created ever more complex programs: the European Financial Stability Facility, the European Stability Mechanism, various forms of quantitative easing, while insisting they could manage the crisis without allowing any major defaults. The reality was that they were using monetary expansion and debt transfers to postpone inevitable adjustments rather than addressing the fundamental problems of excessive debt and uncompetitive economies. Each intervention created new distortions and made the ultimate resolution more difficult and expensive. Today we're seeing the same pattern on a global scale. Central banks have intervened in markets continuously since 2008, suppressing normal price discovery mechanisms through zero interest rates, quantitative easing, and explicit promises to prevent major corrections. The result has been the creation of massive bubbles in stocks, bonds, and real estate that are far larger than anything that existed before government intervention began. Officials continue to claim they can manage these bubbles through careful calibration of policy tools, but the mathematical reality is that the distortions have become so large that any attempt to normalize policy will trigger exactly the crashes they claim they can prevent. Here's why this lie is so dangerous for investors. When you believe that governments can prevent market crashes, you don't prepare for them. You maintain risk levels that would be appropriate only if crashes were truly impossible, and you get destroyed when reality contradicts government promises. I learned early to ignore government promises about crisis prevention and instead watch for the buildup of imbalances that make crashes inevitable. When debt levels become unsustainable, when asset prices disconnect from underlying values, when risk-taking reaches extreme levels, crashes are coming regardless of government intentions. The practical approach is to maintain defensive positions even during periods when government intervention is creating artificial calm. Keep cash reserves, avoid excessive leverage, and remember that the longer governments postpone necessary adjustments, the more violent those adjustments will be when they finally occur. Government intervention doesn't eliminate risk, it redistributes risk through time, usually making future risks much larger in order to reduce current risks. Smart investors position themselves to benefit from this redistribution rather than being destroyed by it. Government lie number 4. Our policies create sustainable prosperity. The fourth lie that repeatedly destroys investor wealth is the claim that government economic policies create sustainable prosperity rather than temporary artificial booms, followed by inevitable busts. Politicians love to take credit for short-term economic improvements while ignoring the long-term costs of their interventions. This lie is particularly seductive because government policies can indeed create temporary periods of apparent prosperity through monetary expansion, fiscal stimulus, and regulatory changes that boost certain sectors. The problem is that these improvements are usually achieved by borrowing from the future rather than creating genuine wealth. I saw this pattern clearly during the Japanese bubble of the 1980s, where government policies designed to stimulate domestic demand created an extraordinary boom in asset prices and economic activity. Japanese officials pointed to rising stock prices, soaring real estate values, and strong GDP growth as evidence that their economic management was superior to Western approaches. The reality was that easy monetary policy and directed credit allocation were creating massive distortions in the Japanese economy. Resources were being allocated based on political considerations and speculative trends rather than genuine economic efficiency. The apparent prosperity was built on unsustainable debt accumulation and asset price inflation. When I analyzed the underlying mathematics, it was clear that Japanese asset prices could only be maintained if the artificial stimulus continued accelerating indefinitely. But no economy can sustain exponential credit growth forever. And when the Bank of Japan finally tightened policy in 1989, the entire structure collapsed. The Japanese economy spent the next 3 decades dealing with the consequences of that artificial boom, despite repeated government promises that new policies would restore sustainable growth. Each new stimulus program created temporary improvements followed by deeper stagnation because the fundamental problem, the accumulated debt and distorted capital allocation from the original bubble, was never addressed. During the housing boom of the 2000s, I watched American politicians from both parties claim that their policies were creating sustainable prosperity through increased home ownership and rising property values. They pointed to strong GDP growth, low unemployment, and rising household wealth as evidence that their approach was working. But the prosperity was entirely artificial, built on massive credit expansion and declining lending standards that allowed people to buy houses they couldn't afford with money that didn't really exist. The government policies that supposedly created this prosperity, Fannie Mae and Freddie Mac guarantees, Community Reinvestment Act requirements, Federal Reserve easy money policies, were actually creating the biggest financial bubble in American history. When the bubble burst in 2007-2008, the same politicians who had claimed credit for the boom denied responsibility for the bust, blaming greedy bankers and predatory lenders, rather than acknowledging that their policies had created the incentives for exactly the behavior they later condemned. Today, we're seeing the same pattern on an even larger scale. Governments around the world point to rising stock markets, low unemployment, and strong consumer spending as evidence that their policies are creating sustainable prosperity. They claim that massive monetary expansion, record government spending, and unprecedented intervention in markets are producing genuine economic growth. But when you examine the underlying fundamentals, the current prosperity is even more artificial than previous bubbles. Corporate earnings are being inflated by stock buybacks funded with cheap debt. Consumer spending is being supported by stimulus payments and asset price appreciation that depends on continued monetary expansion. Government debt has reached levels that can only be sustained if interest rates remain artificially low forever. The mathematical reality is that current prosperity depends entirely on continued acceleration of policies that are already at extreme levels. Just as with Japan in the 1980s and America in the 2000s, the apparent success is actually evidence that a massive crisis is approaching. Here's why this lie is crucial for investors to understand. When you believe that government policies create sustainable prosperity, you invest as if current conditions will continue indefinitely. You ignore warning signs about debt accumulation, asset price distortions, and policy sustainability because you trust that officials know what they're doing. The practical approach is to distinguish between genuine prosperity created by productivity improvements, innovation, and competitive markets, and artificial prosperity created by government intervention. Real prosperity is self-sustaining and builds on itself over time. Artificial prosperity requires ever-increasing intervention to maintain and eventually collapses when the intervention becomes unsustainable. Look for investments that would be profitable even without current government support, and avoid sectors that depend on continued policy intervention for their success. Remember that the more credit government officials take for economic performance, the more likely it is that the performance is artificial and temporary. Government lie number 5. The system is fundamentally sound and stable. The fifth and perhaps most dangerous lie is that our current financial and economic system is fundamentally sound and stable, requiring only minor adjustments and tweaks rather than major structural reforms. This lie prevents people from taking the dramatic steps necessary to protect their wealth when systemic crises are approaching. Government officials, central bankers, and financial regulators have strong incentives to maintain confidence in the system they oversee, even when that system has become dangerously unstable. They reassure investors that problems are temporary, that they have adequate tools to address any issues, and that the fundamental structure of the economy and financial system is solid. I've learned to be most worried when officials are most confident about systemic stability, because this confidence usually indicates that they don't understand the risks they've created or they're deliberately hiding them to prevent panic. In 2007, just months before the financial crisis exploded, Federal Reserve Chairman Ben Bernanke famously declared that the impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained. This wasn't incompetence, it was a deliberate attempt to maintain confidence in a system that officials knew was in serious trouble. The reality was that the subprime crisis was just a visible tip of a massive iceberg of systemic problems that had been building for years. Excessive leverage, interconnected counterparty risks, regulatory capture, and moral hazard from too big to fail guarantees had created a system that was fundamentally unstable and vulnerable to cascade failures. But admitting these systemic problems would have triggered the very crisis that officials were trying to prevent, so they maintained the fiction that problems were isolated and manageable right up until the moment when the entire system nearly collapsed. During the European debt crisis, I've watched the same pattern repeat. European officials insisted that Greece's debt problems were unique and could be resolved without affecting other countries or threatening the euro system. They claimed that firewall mechanisms and ECB backstops made the system fundamentally stable, despite obvious structural flaws. The reality was that the European Monetary Union had been designed with fatal contradictions that made crisis inevitable. Countries with very different economic conditions and fiscal policies were forced to share a common currency without adequate adjustment mechanisms, creating imbalances that could only be resolved through default, devaluation, or massive transfers. Officials knew these problems existed, but couldn't admit them without triggering speculation against weaker countries. So they maintained the fiction that the system was sound, while frantically building bigger and bigger rescue mechanisms to postpone the inevitable reckoning. Today, the same pattern is playing out on a global scale. Officials around the world insist that record debt levels, extreme asset valuations, and unprecedented monetary intervention represent a new normal that is stable and sustainable, rather than signs of systemic instability. Central bank balance sheets have expanded from less than $5 trillion before 2008 to over $30 trillion today, representing an unprecedented experiment in monetary policy that has no historical precedent for successful resolution. Government debt levels in developed countries have reached levels that historically have led to default, devaluation, or hyperinflation. Financial markets have become completely dependent on continued central bank intervention, with any hint of policy normalization triggering immediate corrections that force officials to reverse course and provide even more stimulus. This is not evidence of stability. It's evidence of a system that has become so fragile that it cannot withstand normal economic or financial conditions. Yet officials continue to claim that everything is under control, that they have learned from past mistakes, and that modern policy tools make systemic crises less likely than in the past. They point to sophisticated risk management systems, improved regulation, and better coordination between agencies as evidence that the system is more stable than ever. The mathematical reality is exactly the opposite. The system has become more fragile, more interconnected, and more dependent on continued intervention than at any time in modern history. The very policies that officials claim make the system safer, zero interest rates, quantitative easing, too big to fail guarantees, have actually made it more vulnerable to catastrophic failure. Here's why this lie is the most dangerous of all. When you believe the system is fundamentally stable, you don't prepare for systemic breakdowns. You maintain normal risk levels, hold normal diversification, and trust that markets will continue functioning as they always have. But systemic crises are different from normal market corrections. During systemic crises, correlations between assets approach one, diversification fails, liquidity disappears, and normal market relationships break down. The only protection is to maintain emergency reserves, avoid systemic risks, and position yourself to benefit from the chaos rather than being destroyed by it. The practical approach is to assume that systemic stability is an illusion and that the current system will eventually require major restructuring. This doesn't mean living in constant fear, but it does mean maintaining higher cash reserves, avoiding excessive leverage, and keeping some assets outside the traditional financial system. Remember that throughout history, every unsustainable system has eventually been forced to restructure, regardless of official promises about stability. The question is not whether the current system will change, but when and how that change will occur. The framework for seeing through government lies These 5 lies: inflation control, spending-driven growth, cycle prevention, sustainable prosperity, and systemic stability, form a complete framework for understanding how government propaganda distorts investor decision-making. But seeing through these lies requires more than intellectual understanding. It requires the psychological strength to trust your own analysis over official narratives. The key insight is that governments operate according to political logic rather than economic logic. Their primary goal is maintaining power and avoiding blame, not creating genuine prosperity or financial stability. This means they will always choose policies that provide short-term benefits and postpone long-term costs, regardless of the ultimate consequences. As an investor, your goal is exactly the opposite. You want to identify and invest in genuine long-term value while avoiding the bubbles and distortions created by government intervention. This requires learning to ignore what officials say and focus on what their policies actually accomplish. Throughout my career, I found that the best investment opportunities often arise from betting against government lies when they become obviously unsustainable. The bigger the lie and the more officials insist on its truth, the greater the opportunity when reality finally asserts itself. But timing these opportunities requires patience and discipline. Government lies can persist for years or even decades, supported by massive resources and sophisticated propaganda. The key is to position yourself so that you can survive the artificial conditions created by government intervention while preparing to profit when those conditions inevitably change. The current era represents the culmination of decades of increasingly desperate government lies about economic reality. The lies have become so large and so obvious that maintaining them requires ever more extreme measures. This suggests that we're approaching a point where reality will reassert itself with unprecedented force. The choice is yours. You can continue believing government promises about their ability to manage the economy and control markets, or you can start preparing for the inevitable collapse of these illusions. History shows that those who see through government lies early and position themselves accordingly build enormous wealth, while those who trust official narratives until the end lose everything when reality finally prevails. Remember, the market can remain irrational longer than you can remain solvent, but the same principle applies to government lies. They can persist longer than seems possible, but they cannot persist forever. The mathematics of compound interest, the laws of supply and demand, and the realities of human nature always win in the end. Your job as an investor is to see through the propaganda to the underlying reality and position yourself accordingly. The lies are obvious if you know what to look for. The question is whether you have the courage to act on what you see.